Hey everybody, welcome to this video. My name is Chris Harris, a certified financial planner, and today we're going to be talking about the risk and realities of trying to time the market. As a disclaimer, this video is for informational and educational purposes only and should not be considered tax, legal, or investment advice. Okay, so we have so much uncertainty. Especially we have the conflict in Iran, we have inflation creeping up, we have a new Fed chair, and so there's just so much uncertainty. So I've been getting questions of, well, markets are at all-time highs, so maybe we should start to cut our positions, go to cash, wait for the market to implode, if you will, and then get back in. Or we have people sitting in cash waiting for the market to crash to then get into the market at a better price point, right? And so I wanted to put some data points together in a few slides to hopefully put in perspective historical data and what we look at as it pertains to trying to time the market and why that may not be the best idea just from a mathematical standpoint. Again, this is just, we're looking at the S&P in most of these data sets and then just some historical values there. So hopefully, this makes sense and it's not too overwhelming, but we'll see how we do. So let's dive in. We are going to start with just I think a really important part of investing, and that's volatility, right? And that's something that is measured by what's called the CBOE VIX index. And we can see, so this data set is from 2010 to May 12th of 2026 was the last data point on this one. And so as we can see here, we have different world events, if you will. And so just more recently, we can see the tariffs here. We saw a spike in volatility, right? And even during COVID as well, we saw another spike here, inflation, trade wars back in 2018. And so there's a lot of volatility around geopolitical events and things like this. Now, if we look at the average VIX, so just again, this is the volatility kind of indicator, if you will. It hovers around 18.4, right? And right around now, we're hovering around 18. Now, this constantly changes. But out of this chart, out of this graph, really the main takeaway here is that volatility is just inherently a part of investing, right? Taking on risk is a part of investing. So it's something that if you are new to investing or maybe you've been investing for a while now, and you still get the jitters, know that it is a part of just the market environment, right? Just a part of having your money invested in some sort of an asset. You're going to have volatility, or it could be a debt position, right? Fixed income or equity or whatever. You're going to have some risk that you're taking on. And so it's something to really get comfortable with, knowing that there is volatility just in the market. And as we have more volatility, it doesn't necessarily mean that we have to jump ship and kind of rewrite where we've been going. It just means that we have to come to terms with being patient, right? The next slide, so this is annual returns and pullbacks, and I really like this one. I show this one to clients a lot because I think it puts it into perspective in terms of how many drawdowns, or not how many, but what's the max drawdown that we have in any given year, okay? And so we can look at the S&P 500 since 1918. So that's our period set until, again, May 12th, 2026. So if we go ahead and look at even, last year, we can look and we said, okay, we had, and this was during the tariff situation. So we were down negative 19% during the year at one point, but we ended the year at a positive 16%. Okay, year before that, we were positive 23%, but we were at, negative 8 at one point during the year. Okay, so on and so forth. We can see even during the pandemic, we were negative 34%, but we ended the year positive 16. Okay. Does that mean that it's always going to happen that way? Absolutely not. As we can see, we have these periods of time. So this was during 2018, where we had a negative 20, but we were negative 6%, or even if we go sooner than that, so more recent, I guess, we were negative 25%, but we were down negative 19%. We ended the year at negative 19% in 2022. And then you can even see, we have the great financial recession right here. We were down, market got creamed there. We have the dot-com period here, so the dot-com bubble. As you can see, so the market, just because we have downturns doesn't mean we're always going to have positive numbers at the end of the year. But what I like to look at is, if you can see this chart, it actually looks like we have more of those bar charts above, right, as opposed to below, right? So just looking at that chart, you can say, oh, well, that gives me a pretty good idea. Over the last 46 years, the market has more often than not done well, right? So again, I think it's an important piece of information just to look at historically, to just give us a little bit of perspective as we invest today. But again, this does not mean that we're going to have positive returns in the future, right? Stock market pullback. So this is another one that I think is important to look at as well. So we look at pullbacks. So the number of 5% S&P 500 pullbacks experienced by an investor each year, okay? So again, the same data set point here from 1980 to May 12th of 2026. So if we look at this, taking last year, for example, we had 6 pullbacks. Okay, so that means that we dropped the market, S&P 500, had 5% or greater pullbacks, or 6 pullbacks of 5% or greater last year, but we were still positive, and that's what we saw on the chart below. But if you can look at this, we have an average of 4.6 pullbacks per year, right? So that means that we're going to have a lot of volatility, right? Just in any given year, we're going to have 5% or greater pullbacks in any given year, even on positive years. So that's just something I think to keep in perspective. And by looking at the data, we can say, okay, again, inherently, we're going to have pullbacks. We're going to have an average of 4.6 pullbacks. Again, taking the data set from 1980 or since 1980, 4.6 on average, we can kind of expect that we're going to have around there, maybe a little bit less, maybe a little bit more. We're obviously going to have outliers that can really shake things up a little bit more. But again, it's just, I think, really driving home the message that volatility, again, is important, or not important, but a part of investing, okay? So this one's interesting, market corrections and recoveries. So if we look at the S&P 500 returns since World War II, if we look at market corrections from peak to trough, are declines of 10% to 20%. So that's what we talk about when we talk about corrections, okay? So as you can see, this dark blue line here, that's the averages, okay, of all the corrections since World War II. The market falls negative 14.3% during the average correction. The average recovery only takes 4 months, okay, out of this data set. So if we think about it, 4 months isn't really that long, right? And this is really where asset allocation becomes very important, right? But 4 months is not that long after a negative 14.3% drop, okay? So again, it's one of those things where it becomes very, very difficult to try to time when we start seeing these corrections to say, okay, well, let's, get in. We don't know where we're at in the cycle. We don't know kind of when we're going to go back up, those type of things. So it becomes very difficult. Bear market. So this is the same period. So we look at S&P 500 since World War II. Okay. Bear markets are peak to trough declines of 20% or worse. And so we look at this bold line again. This is the average. okay, in the data set. So the market falls negative 34.7% during the average bear market. Okay, so it's pretty steep, right? Negative 34.7%. The average recovery takes 2 years and 2 months. Okay, so you think about that. Okay, so the deeper or the more the market falls, the longer that it's going to take for us to recover out of that, right? 2 years and 2 months seems like a long time. If you put that again into a little bit of perspective, if you are in your retirement years, that probably looks a little different depending on how you're allocated. And again, I said this before, but that's why asset allocation becomes very, very important. That's why we don't just, say, hey, put you in the S&P 500 when you're retired, and hopefully you can, survive, especially if you have these type of market situations, right? And so this becomes something where if we're younger, then we can take on more of this risk, right, of having these longer recovery periods. So again, 2 years, 2 months doesn't seem like, seems like a longer time, but in the grand scheme of things, 2 years and 2 months, it can go by pretty quickly, especially if you can continue to dollar cost average during these down periods. Okay. Staying invested. So this is missing the best days. I like this chart because I think it just kind of demonstrates that if we try to time the market, we pull out, we try to invest, we're missing good days of market recoveries, right? And that's what's really, really hard. It's you can pull out and you can say, okay, I pulled out and I hit the nail on the head, so to speak, right? Say the market starts falling, you pull out. That's fine. But the really difficult thing is when to get back into the market. When is that kind of bottom? And because we've seen, especially in the last few years, the market has really recovered very, very quickly. And so you miss a lot of these big days where we have a lot of, the market does very, very well in just a few days. So to get back in is very, very difficult to time that. So this chart is showing the impact of missing the best market days over the past 25 years. So this is based on an initial $1,000 investment using the S&P 500 returns before transaction costs. Okay, so we're putting $1,000 into the S&P 500, taking the last 25 years, and we're saying if we just held that, okay, through the last 25 years, our $1,000 would grow to $6,324. If we were to miss the best day out of that time period set, our portfolio would drop to $5,668, down from this $6,324. And then, as you can see, if we miss the best 5 days, okay, down here, our portfolio would have a dramatic drop. So we would only have $3,908 at the end of that period. Now, we keep going down. As you can see, there's kind of a theme here. The more good days we miss, obviously, the more our portfolio will not, have that growth component to it. Now, if we miss 40 of the best days, so we kind of break even at 30 days. At 40 days, we are below our initial amount invested. So that just means that we had more losses, right, as opposed to wins. And so that becomes very telling that it is important to capture a lot of those good days, right? Because the market can reverse very, very quickly. And if we're trying to time just by missing one of those good days, the best day of the market that the market had over the past 25 years, our account drops pretty significantly. Okay. So again, it's one of those things where we try to take the emotion out of it and say, okay, what are we trying to accomplish? That's where financial planning, asset allocation really come together to help from a portfolio standpoint to understand, okay, we can take risk, or we got to, take risk off the table because the market is so volatile and it's very unpredictable. Okay. So we're going to look at stock market drawdowns since 1928. I like this chart because it just shows these drawdowns in a very, I think, graphical way easy to understand. So if we look at this, so we're taking the S&P 500 in a log scale. We have the crash of 1929. Obviously, Great Depression. Look at that. So we can just see here, we had a lot of drawdowns, and they were massive, right? Market was really struggling. We have World War II, so we have all these different events, Reagan, the tech bubble, housing bubble, global financial recession. So all these different, world events that affect the market. And we can see how many drawdowns we've had, right? And how long they've been spaced out. So they are, again, looking at the data, we can make that assumption that just by being invested, we are going to have, these drawdowns, right? But we can also see that the market continues to press forward, right? It continues to do its thing, to perform. And so really, again, I think it's a nice graphic to show that we're going to have these drawdowns. We're going to have periods of volatility, but what are we willing to do from a patient standpoint to ride through these waves, right? To ride through the downs and the ups. Are we going to be emotionally able to sleep at night, right? When we see our portfolio make these drastic drops and things like that. So it's just something to think about when it comes to your own portfolio as well. So, and we're almost done here. So I don't want to bore you to death, but hopefully you've captured some of what we're trying to accomplish on this video, and that's just to show the actual data, right? Stock market bull and bear cycles. So we have the bull market right here. So these these big gray areas. So that's the bull markets. Bear markets are a 20% decline, like we already talked about. From price, 20% declines in price from prior peaks, and then we have the bull market starting at the bottom of each period market bottom here. So as we can see, the recession periods are the gray shaded bars. So we have a recession, so a bear market, and then this goes into a bull market. Okay, so you can see we have these, again, kind of zooming out, we can see all these bear markets, right? So all these bear markets. And it looks like, again, from the chart, we definitely have more of these bull markets, right? So if we look at this one, so from 1990 to 2000, we had a 12-year period, 12-year and 3-month bull market. So the market did 582% over that period of time. And then we had a pretty good correction here. So this bull or bear market, we were down negative 49%, and it lasted 2 years and 6 months. And then the market in a 5-year period we returned 101%, so on and so forth. We're currently in a bull market period we've gone 3 years and 6 months, and the market has returned 107% in that time period. So it's, again, it's one of those things where you just gotta take a step back and look at the whole data set. From here, we do have these long bull market periods, obviously followed by, a bear market. And so it is an inherent part of investing to have these crashes, to have these cycles. And so it just comes down to the question is, are we prepared? Is our portfolio prepared to weather the storms? Maybe we're taking income from our portfolio or whatever it is, withdrawals. Are we prepared to weather these storms with how we are allocated, right? And if we're young enough, then it's like, can we ride that wave all the way through? So there's just, it depends on what we're saving for, what we're trying to accomplish. But taking a step back, we can see how many bull markets we've had just over the past 50 since 1956. Okay. So I just think it's pretty interesting to look at that chart. Okay, last one here. So I think this one we look at, it's interesting. I think it puts it in, again, in a little bit more perspective, right? Annual stock market return ranges. So there's the S&P 500 by your annual price returns. And so how this chart is positioned, we have all your positive, okay, gains here, and then these are your negative gains in the S&P 500. This is dating back to 1931, I believe. And so as we look at this, and then just right off of this chart, it's interesting because we can see that there are more positive years than there are negative years. Okay, so these are negatives, these are positives. So positive year, we have 68% of the time the market's positive. Okay, 32% of the time the market's negative. So again, it's kind of looking at this from like a batting average standpoint, or you could think of like professional sports. You know, we are, from a market standpoint, you know, positive most of the time. Like if you were batting, you know, or even shooting, if you go NBA or whatever, if you're shooting 68% from free throw or from 3-pointers, you're doing pretty good, right? That's a pretty good statistic there. And so 68% of the time over the course of the history of the market is pretty good, right? Again, this is just in the S&P 500. And so hopefully you can take that data and say, hey, you know, even though there are a lot of drawdowns and there are bubbles and the market does crash, these things do happen. It's important to ride the wave, right? To have that long-term perspective. And if you have the financial planning, you have your goals, your time horizon, those things are dialed in, then your portfolio should be able to weather the storm, right? Again, if you've set it up properly. And so that's the main takeaway of this video, is hopefully giving you a little bit of, you know, perspective on the long game, right? And doing those things to prepare for, you know, market conditions. Because if you have a plan that fits into how your portfolio is allocated, then you should know, okay, even though, you know, we have a 20-30% drop or whatever that is, we still have a plan in place to say, hey, this is our trajectory for retirement, or even if in retirement, if we're taking income, that's why we plan for those things. So again, take a step out, take a step back. There's a lot of fear mongering going on, especially right now with markets being at all-time highs. A lot of stuff on social media, I think, trying to get people to react in a way because you know, investing is so emotional. But I think, again, taking a step back and realizing that the market does go down, right? Your portfolio will go down in those, you know, situations if you're invested in, you know, whatever equities, S&P 500, right? It has the ability to go down. But also, if you look at the whole data set, then you can make that assumption that, you know, the market does do well over time. And so take that. Hopefully that gives you a little bit more confidence as you have your portfolio, your investments, as you look at the current market, you know, conditions, and you hopefully are able to take a step outside of those emotions and say, okay, you know, looking at data, looking at the big picture, I'm able to make, you know, those decisions rationally, right? Okay, thanks for watching. Hopefully this helped, and good luck as it pertains to your own portfolio, and we'll catch you on the next video.